My name is Assis Malakias. It gives me great pleasure to welcome you all to the Africa Sessions. The main objective of the Africa Sessions series of virtual conferences, part of a global strategic platform, is to foster analytical dialogue between experts on critical and timely themes, using an online platform to bring the discussion to a wide global audience. Besides live transmissions, the conferences will be available on social networks for later viewing and may be used for production of written materials. The Africa Sessions are held monthly, and the main participants are analysts, academics, government officials, journalists, and other opinion makers. The target audience includes academics, business leaders, government officials, analysts, students, and the general public. In terms of format, the Africa Sessions offer 90 minutes of online debates with experts and moderators. COVID-19 provided the impetus for this important initiative. Among other things, the pandemic exposed serious deficits in terms of strategic thinking to address global challenges. The Africa Sessions, and more broadly, the global strategic platform, will go a long way to help alleviate these deficits. To get the session started, I will ask Elsa Moraes Sarmento to introduce the theme for today, as well as the panelists and moderators. Elsa, please take it away. Thank you.
Thank you. Hello, everyone. It's a pleasure being here. The topic of our discussion of today is about Africa after COVID-19, key economic challenges. The structure of our discussion will be along 3 different rounds, which will last for about half an hour each. The first round is entitled African Economic Growth Challenges. And it has to do with the impact that COVID-19 has had on the continent. We know that there are still serious risks, and this event represents a serious wake-up call to the continent's enduring vulnerabilities and challenges in several areas, namely, of course, in health and development as well. Africa's growth prospects are very much compromised and are expected to weaken significantly, due not only to COVID-19, but also as a result of the global economic slowdown, which will certainly take a toll on international trade, foreign direct investment, but also, I believe, to an extent on international aid and also development cooperation. The second round will be about testing African resilience amid the global economic slowdown. So it has to do about the long-term damage on economies worldwide, which is likely to be deep and long-lasting. And we'd like to see to what extent has COVID-19 shattered the idea of an African economic resurgence towards the transformation of the continent into an economic powerhouse, which was already underway. The third round has to do with looking ahead into the future and on how to overcome Africa's development challenges. So we know that most African countries have thus far sort of, still, or some fail to fully fulfill the economic development expectations of their populations. There is still widespread lack of infrastructure in energy, water, sanitation, and so on, extreme poverty, income inequality, unemployment, several issues that are still enduring. And this will be the wrapping up round and session of our discussion. So with us today, we have as a host, and if you forgive me, I will be dropping academic titles. We have Salim Vali Mamade. He's a lecturer at the Catholic University of Angola and board member of the bank Huambo. He's also the former director of executive programs at the Catholic Luanda Business School. As distinguished moderators, we have Srikesh Lashmidas. He's Deputy Editor-in-Chief of a leading Portuguese economics and business newspaper called Jornal Económico. He has been in the past Reuters agency's correspondent in Angola. We also have with us Joel Costa. He works for a leading Angolan business and economics newspaper called Expansão. He was the deputy coordinator for the setting up of the American Chamber of Commerce in Angola. And we also have with us 5 distinguished guest speakers, our panelists. So we have with us Ottaviano Canuto. He is a senior fellow at the Policy Center for the New South and Brookings Institution and former vice president of the World Bank. We also have Jan Isaacsen, emeritus researcher at the Christian Michelsen Institute, CMI, in Norway. We also have with us today Alan Hirsch from the University of Cape Town, Nelson Mandela School of Public Government in South Africa. With us also Jean-Louis Arquin from the Graduate Institute of International and Development Studies, Geneva, Switzerland. And finally, last but not least, Grant Harris. He's now the CEO at the Harris Africa Partners, a boutique advisory firm that advises companies on doing business in Africa. He was previously special assistant to President Obama and also senior director for African affairs at the White House from 2011 to 2015. In that role, he was the president's senior advisor for Africa and also responsible for the US-Africa policy. So that's all on my side. Thank you so much. Over to the moderators.
Thank you very much. Also, thank you very much, Assis, as well. Thank you very much for all the members of the illustrious members of the panel for taking part in this second Africa session. Without wasting more of your time, I'll start the first round. As Elsa mentioned, it is about the economic growth challenges that Africa faces. In this context of COVID-19, it's a real reminder that the continent still faces challenges and has vulnerabilities that will require deep strategic thinking to place it on a firmer and more sustainable growth path. It's also expected that the growth prospects will weaken significantly with the pandemic as it acts as a strong headwind against global economic activity. For example, as we've seen the decline in the commodity prices, especially oil, lower exports due to lower external demand, and also private consumption lowering as a result. There's less space for fiscal measures from government expenditure, less private investment, more debt, and so on. These are issues that we've been seeing already in the last couple of months, and which we'd like to discuss in this round. Our first question is for Alan Hirsch. Alan, good afternoon. What, in your view, are the key economic growth challenges in Africa that have been precipitated or hastened by the COVID-19 pandemic?
Good afternoon, Srikesh, and good afternoon to everybody who's participating. Clearly, I'm not going to talk about health issues except where they're economic issues, but obviously they are critical as well. But clearly we've had a massive global slowdown. More countries have slowed down at the same time than at any other time in history. It hasn't been like any other previous crisis in terms of the coincidence of the slowdowns. And that's meant that the demand for many products produced in Africa has plummeted sharply. Just one example, oil. The price of oil, as we know, has collapsed. For a country like Nigeria, it's one of the major exports. It's possible that Nigerian exports of oil could fall by half from about $52 billion to about $26 billion. Nigeria has already been forced to devalue the Naira and may be forced to do that again. So it has a critical impact on commodities like oil and on some other African exports as well. A second major impact has been that remittances of Africans around the world in other parts of Africa to their home countries have slowed down really sharply. It's estimated that remittances will be cut by about 30% over the year. As many people probably know, remittances are a more important source of funds in African countries today than all the ODA that they receive put together. So it's a really significant impact. Risk aversion, as a result of the uncertainty and the slowdown, has meant that capital's not only stopped flowing to Africa, capital has reversed itself out of Africa. So Africa is starving for investment, it's starving for foreign exchange. That's made it obviously really difficult or impossible for African countries, or all those factors together have made it difficult for African countries to repay their debts. Some African countries got into very high levels of debt over the last decade or so, partly because many African countries entered the sovereign bond market for the first time in the last 10 years, and the market was very keen to lend to Africa. It's also meant that this lack of foreign exchange has meant that it's difficult for some African countries to buy key imports, including inputs into production, but also food and medical supplies, and that could be really critical. Many African countries have had social distancing, have had lockdowns, and have therefore also curtailed the domestic sector and domestic demand. And why that's important is not only because of the overall decline in demand, but also because where African countries have been cutting back on economic activity, the biggest impact has been in many countries on the informal sector, on the marginal poor, who are a very large part of many African countries. They're also the most difficult people to reach through social transfers and other forms of compensation. So the inequality impact of the slowdown has been really serious. Some supply chains have been broken or damaged, and African producers have not been able to produce because they haven't been able to get inputs, either because the supplier countries haven't been producing those inputs, or because they are no longer exporting those products for whatever reasons. There's a certain amount of inward-looking behavior by many countries around the world. Finally, the collapse of international travel has meant that many African countries, which depend on foreign tourism, and many African countries do, countries like Mauritius, Cabo Verde, Seychelles, Ethiopia, have been really badly hit. In Ethiopia's case, for example, Ethiopian Airlines is said to, and I haven't checked this, but they're said to contribute 5% of Ethiopia's GDP, and it's virtually come to a standstill. So the impact has been very significant, Shrikesh.
Thank you, Alan.
Joel?
I'll take the second question as well in that case. Jean-Louis, this is the second question is for you. We want to know which measures, which specific measures must be implemented immediately to overcome these challenges that are exposed by COVID-19, especially to minimize the social impacts, including poverty, unemployment, and the widening gap between the social classes. What are the urgent measures that need to be put in place, in your view?
Look, the COVID-19 epidemic has simply, essentially, exacerbated problems which existed before, as Alan was saying before me, and it's just the nth shock in a series of shocks which which have been hitting Africa. Conceptually, as an economist, I mean, if you sort of want to think of what's going on, is in the greater north, in rich countries, let's put it that way, the thing that we heard for months was flatten the curve, flatten the curve. So we flatten the curve, fine, there are averted deaths in the north. The problem is that there's essentially a multiplier effect that Alan was also referring to between rich countries and Africa that reduces economic activity in Africa, and therefore that heightens the curve in Africa. So if you sort of want to think about this conceptually, what this crisis has done is, what we've essentially had is a death transfer. I know that doesn't sound very pleasant, but that's what it is. We've had a death transfer from the developed world to the developing world, and Africa in particular. The policy responses, the second part of my answer, the policy responses to this are very similar, obviously, to what one sees in rich countries, but with some specificities. And for the viewers out there, there are two papers that you might want to go and take a look at, which I find are again, get an economist friend of yours to explain them to you. There's some amazing work which has been done by Daron Acemoglu and company at MIT. This is, I think it came out in April. And then there's also some work which was done by a bunch of people at San Diego, UC San Diego. And what they found is that both in developed countries and in developing countries, age-specific lockdowns are extremely effective. You basically don't get anything more. This is simulation evidence. Okay, it's very difficult to establish causality using the empirical data that we have, but age-specific lockdowns seem to be the way to go, where you're basically trying to lock down the vulnerable population. And this is particularly important, obviously, in Africa. We'll come back to this later on, given the age structure of the population in Africa, which is completely different from the rest of the world. Third point, again, for those who know me, they always hear me sort of hammering this sort of stuff as a development economist. I'd say, third, we've got what I like to call the 3 I's. And the 3 I's are institutions, infrastructure, and inequality. When I talk about institutions, this also Alan referred to, and my colleagues will be referring to this as well. Institutions, we're talking sort of in the Acemoglu sense of economic institutions. We'll be coming back to governance later on in this in the session today, but that's something that's always been a problem. It's still there. It becomes even more important now. Infrastructure, when I talk about infrastructure, it's not just building highways, it's also healthcare infrastructure, right? This is where Africa is incredibly deficient. And third, inequality. Africa has governments, because of the lack of governance, have a very limited ability to redistribute to protect those people. But we'll be coming back, I think, to all of these themes later on in the Africa session today. Back to you.
I think my colleague Joel is having some technical problems. Joel, you there? And moving on, I can ask the question again. This question is for Jan Isaacson. Jan, what do you see as the correct mix of fiscal and monetary policies to address these current challenges? Is it possible to control inflation and have quantitative easing, for example, at the same time? Which policy balance is needed?
Well, before I start answering that, a little bit of the background, I think it's necessary for some to have the backdrop, where we have the crisis that hits not only demand but also supply, hit on both sides. And the job is now, both during the crisis, as it was during the peak of the crisis, which might have happened, hopefully, and later as it recedes, the job is to stimulate dying economies to come to life. So there we need both fiscal and monetary policies on both supply and demand side. But we know that even at the onset of the crisis, the African countries were heading into debt problems, most of them. And they had little fiscal space. It's mentioned time after time. And in addition, as also been mentioned now, the systems and institutions which are supposed to deliver measures are weak. So as the crisis evolved, there was some desperate funding needs for the health system in particular that made the whole system worse. And this is affected, obviously, all African countries. To cite one, South Africa, I read today that Taito Mboweni, the finance minister, said that we are no longer as rich as we used to think we are. We had to adapt to a new situation, think seriously about going to zero-based budgeting. And to say zero-based budgeting for a finance minister is serious. So presently then, a lot of countries have limited possibilities to continue what they should be doing, namely demand-driving budget measures on the fiscal side. Much of the, I would say, fiscal maneuverability was used in a panic in the first few weeks. Nobody expected the crisis to go on as long as it actually has. And the real truth is that we even now don't know. There is an uptick of the virus infections in certain countries, and we don't know where that will go. In the relative terms, the stimulus measures that the African countries have been able to deliver has been very small, puny, compared to those of the Western countries. While the measures in percent of GDP in Africa often has been lower than 1%, South Africa and Cote d'Ivoire has had somewhat more. The Western countries have often been spending up at the 10% level, 6% in Canada, I read, 15% in the US, while Japan is rumored to have spent over 42%. And if you take into consideration not only GDP percentage, but the real money, we know that GDPs are smaller in Africa, so they have been able to use is very little. In terms of monetary measures, the countries have now used a considerable part of their space for further demand boosting and then investment measures. From March, April until now, the single interest rates of the central banks have been reduced with 50, 100, 200 basis points. In Egypt, about 300. And significant part of the buffers that some countries had managed to set aside has been blown. And now to move further with stimulation under this kind of situation is extremely difficult. Particularly because of the lack of fiscal space. It's not a matter of being clever and deciding clever things. It's a matter of getting the room to actually spend and boost the economies. And compared to the size of the crisis and the former crisis we've had, the support coming from outside Africa has been small, inadequate. And looking at the comparative sizes of the economies, we easily find that it would certainly be within the ability of Western countries to support much more or somewhat near the real needs, but they fall clearly short of it so far. They have not come up. They've come up to a lesser extent than they have to former crises. So the type of mix between fiscal and monetary measures appears to me less important. What is sure is that the situation requires measures not only from the central bank. Fiscal and monetary authorities must work together and coordinate. So given the limited means, going forward is more important than ever to use the means to the greatest effect. So a general stimulation policy is certainly necessary, but the fact that the downturn has hit, first of all, different parts of the economy with different strengths, and that it is urgently necessary to direct particular government expenditure towards the poorer segment of the population, means that a more precise targeting of measures is very important going forward. Now, the question was also on the massive demand stimulation and inflation. To me, it seems a bit unlikely that that will be a main concern, given the disastrously low demand experience by most African countries. Also, we have in line with the specifics of support, if we can target the supply side, stimulate the supply side and take away bottlenecks in terms of production of various goods like medicines, it will help to remove the inflation. I'd like to round off. I've spoken too long, but I would like to say something about a hobby horse of mine, and that is statistics. While we need monitoring and the precise targeting, and this is mentioned all over all the time, we need that. The means to provide that go through statistics. We need to know to be able to do good work in being precise with our management of the economy. Many African countries seem to be flying into what might be a storm blindfolded. To know the size and the shape of poverty and the vulnerable groups, we need descriptions and numbers. And to know which industries are worst hit and which are strategically the most important, we need proper industrial statistics. Uncovered needs exist in so many areas, like types and prices of goods traded and produced, health and health sector statistics, the size of stocks of food and medical equipment, hospital capacity, etc., etc. It's easy to believe in the fallacy that data can be provided when the need is there. I say no, a statistical system and good routines and institutions will have to be built up before the storm comes. A little money used on the building of systems will go a long way to forecast the existence and the size and the shape of crisis and help us fashion appropriate fiscal and monetary measures. Thank you very much. I've spoken too long, but
no problem.
That was that.
Thank you, Grant. Thank you, Grant. I'll take the next question. It goes to Ottaviano Canuto. Ottaviano, is it realistic to expect that international financial institutions to bail out African countries? If so, what conditions should Africa expect and what impact will they have?
Right. Thank you. Thank you very much for having me here. What Alan, Jan, and Grant aptly described is what I have called a perfect storm that coronavirus has brought to developing countries in general, and in Africa in particular. It's a perfect storm because even before coronavirus start being spread and taking over the terrain in the region, some shocks from abroad were already at play. And they have been mentioned, as Alan said, the commodity price shocks, differentiated between agriculture on the one side and on the other, the metal and oil particularly, remittance, tourism, supply shocks as well, but also a financial shock provoked by risk aversion. This was humongous. is the same phenomenon that explains how we had over 3 weeks in February and March the downfall of asset prices in major advanced economies, both equity and debt, also the outflow around $100 billion from emerging markets as a whole. And also, of course, the drought in other sources of finance to developing countries. On top of that, as very well said by Jean-Louis and also Jan, flattening the curve of pandemics in Africa, like in many other developing countries, has faced peculiar challenges because of the essential part of the population living in slums, which makes difficult the implementation of social distancing policies, but also because the level of healthcare capacity to which the pandemic curve has to flatten in order to fit are inevitably, let's say, narrower than it is the case of advanced economies. Even among advanced economies, one knows those healthcare capacity. Germany has more healthcare capacity to attend coronavirus patients than, for instance, Italy and Spain together. So, and this applies even further in the case of developing countries, including Africa. But also the policy response approach by Jan and Grant, they are harder to implement given the levels of informality in occupation, ranging from 50% in the case of some middle-income countries up to 90% in the case of low-income countries. That makes it harder to implement policies of income transfers to those directly affected by the social distancing policies and so on. In this nightmare, this perfect storm translates itself, of course, into fiscal pressures. It's not by chance that the fiscal deficits on average are bound to go up by more than 5 percentage points in the region, in some cases more dramatically. Now, so we have fiscal challenges, while at the same time, commitments associated with the previous debt is also weighing on balance of, and that's where IMF and World Bank, let's say, would weigh in. Now, we need to be realistic in 2 major respects. First of all, the size. The World Bank, I know, I'm no longer there, but I know of the effort that to speed up some financing lines, particularly directed at boosting the healthcare system. I know of the effort to relocate from the lending space that was available for some upper middle income countries in order to make them more available to lower middle income countries. But the fact is that the size of what is available from the World Bank and other lending institutions, multilateral lending institutions, is not, let's say, very large enough to think of a bailout by those long-term funding providers. In the case of the IMF, which is here that the short-term needs, balance of payment needs, and fiscal needs in the short term, there is a lending capacity around $1 trillion. I know how my former colleagues, I spent some time at the IMF as well, how Kristalina Georgieva has made a shuffle of lending space. More than 100 countries requested emergency support, but those emergency support are tiny. We're talking about here $10 billion of emergency support for almost 100 countries requested emergency support. But this is tiny vis-a-vis the needs. But of course, the $1 trillion lending facility is still not enough to cover, let's say, what the set of developing countries, including in African countries, we need probably to solve entirely the issues of balance of payments this year and in the future. And then I come to one important principle that has been firm, established on the IMF side is not to lend to countries in conditions of a clear debt unsustainability. For obvious reasons. The last case where we saw a move like this was the engagement of the IMF in the package to rescue Greece. The second one, when it was clear, I was at IMF at the time, I was on the board, it was clear that the debt trajectory of Greece was clearly unsustainable by any mechanics that one used to estimate the path in the future. Nonetheless, because of insistence from the side of Germany and the European community, there was no debt renegotiation, only to happen later on a third phase when we had the debt relief to Greece. It's a specific story, but what I'm recalling this episode that it is has been confirmed the opinion at the IMF held by all stakeholders that there is not going to be IMF rescue package to countries the debt of which, the public debt of which, or the foreign debt of which is unsustainable. And then we come to at play, the coronavirus. A wise call was made by both the IMF and the World Bank to the G20 countries to suspend the payment on the official bilateral debt of low-income countries affected by the crisis. And that was approved by the, it was accepted by the G20 countries in their meeting, followed. But not all, for instance, not all African countries have opted for taking this offer. Zambia has, but Zambia is in a very dire situation when it comes to debt, when it comes to balance of payments conditions, whereas some other countries said, no, we don't want it. And the issue is that these other countries have, let's say, appreciated very much their success in recent years to issue bonds, even 30-year bonds. And they are correctly afraid that accepting the offer of debt relief from G20 countries might jeopardize their private creditors. This has meant, when you take the rating agencies, they have issued ambiguous statements, but they give an impression that they might downgrade countries that accept that relief. My point to this is the following, and let me summarize my take on it.
Thank you.
IMF will probably come with an evaluation of debt trajectories that might take them as unsustainable in some case. And it's not clear whether the countries, the potential recipients of those funds, would accept go down the road of debt renegotiation. We have a very heterogeneous picture in the continent with respect to the acceptance of the terms of support by the IMF.
Thank you, Ottaviano. And the next and last question for this first round about African economic growth challenges goes to Grant Harris. Grant, China has been a key economic and financial partner for many African states. How is the pandemic affecting this relationship? With greater difficulty in repaying debt, will African states have to ask China for restructuring? And what role can other powers play, for example, the USA?
Thank you. It's a great set of questions. I think to start, it's important to recognize just how important of an economic partner China is. It's the continent's largest single trading partner, and its foreign direct investment has been increasing by leaps and bounds over the last couple of decades. It's also a very multifaceted relationship. So it's not just economic, but it has really deepened political ties in terms of formal linkages with ruling political parties. It has deepened cultural exchanges, founding Confucius Institutes, having more students study abroad from Africa in China. It has been training more journalists, and so it has really deepened the relationship. The economic piece of that is that going back really to China's premier infrastructure initiative, the Belt and Road Initiative, which, as everyone knows, is really ambition on a very grand scale. It was meant to include about a third of all world trade and GDP and over 60% of the world's population by the estimate of the World Bank. As many people, though, have already commented, many African states have a significant debt burden. And though it's not all from Chinese loans are an important element of this, particularly for the infrastructure projects as part of the BRI initiative. And many sub-Saharan African countries right now owe about 30 to 40% of their total external debt to China, which is significant. And for some countries, it is significantly higher. For Djibouti, for instance, China holds more than 70% of Djibouti's GDP in debt. These are important not only for the economic factors, but for geopolitical reasons as well. In the case of Djibouti, it's a very geographically important country where the US and China and others have military bases. And you can, some have argued that the level of debt would give China a degree of control and influence over a government that would really advance its geopolitical interests much more than what the economics would merit. And they've pointed to the case in Sri Lanka as well of the port of Hambantota essentially being ceded to China when the Sri Lankan government was not able to repay its massive debt load. So that's a geopolitical issue I think that is out there. What we need to consider also, given coronavirus, is that this debt, particularly to China, and particularly as it relates to infrastructure projects, could get significantly worse. And Felix Chang at the Foreign Policy Research Institute and others have commented on this, but the idea is quite simple. As in building these large new projects, they need to be sustained with global demand. And as global trade and global demand might or will be decreasing in this stage of recession, that would mean that these new projects are competing with the existing projects and cannibalizing existing infrastructure, which would mean that the debt service would be all the harder. So getting back to the question of debt relief and what that would look like, African states have been asking for debt relief. They've made a very strong case for it. The G20 did reach an agreement on debt relief, but it is a standstill. It's not debt cancellation. That means that there was an agreement to suspend debt payments through the end of 2020. That will be helpful, but that's not at all what would be needed to free up the type of liquidity that African states will need. And I know we'll be talking more about that with future questions. China has also announced that it's going to give $2 billion to COVID-affected countries. What that means, though, is not entirely clear, and many suspect that there'll be some double counting of WHO contributions that have already been made, money already put towards debt suspension, etc. The bottom line, though, is that many African states will need to seek debt relief of some sort, particularly to China as a bilateral creditor. China does not operate in the multilateral confines of or multilateral practices of the Paris Club. And what I mean here is that Chinese debt is quite opaque. Nobody knows exactly how much it is. There are estimates, including estimates that there is as much as $200 billion of Chinese debt off books to emerging markets worldwide. So citizens of these countries don't know exactly what was promised in terms of resources or strategic infrastructure as collateral. And oftentimes in these bilateral negotiations, it could mean a country emerging with more obligations to do future deals or to include more Chinese companies. So I think it's going to be a very important space to watch. The final piece was what other powers and countries can help. And I think it is important for those countries to continue to encourage transparency in lending, and it's important for them to work through the G20 and the World Bank and IMF to provide as much debt relief as possible. African states sorely need this. I think there's a strong case for it, as other speakers have already mentioned. And I think that that's a role that other countries really need to play. But China, I hope, will be quite responsible, but I think that their past practice and the opacity of the debt and the way that they're approaching it doesn't give me as much optimism that this will be handled the right way.
Thank you, Grant. Let's go to the second round. It's about testing African resilience amid the global economic slowdown. The impact of COVID-19 on global economic growth has been both abrupt and deeply negative. The long-term damage on economics worldwide is likely to be profound. Well, this question goes to Ottaviano Canuto. Ottaviano, has COVID-19 shattered the idea of an African economic insurgence within a context of globalization?
Thank you. Not necessarily so, but let me explain my viewpoint on this. It will all depend on two sets of factors. On the one side, the shape of economic recovery after coronavirus, whether it's going to be, where there's going to be scars left on the economic body of the region, because that might define whether we, the region or the countries in the region, follow some sort of U-shaped curve, or whether an L curve, one in which you have a decline in the GDP and the GDP returns to the old trajectory, but at a lower level. But it will also depend, the second set of factors, on to what extent and directions will globalization change. Some things we know about the world post-coronavirus, which how it will be different in some respects, besides the obvious higher levels of debt that will be all over the world. No matter where you are, you're going to have either a higher public debt and or higher private debt. This is a given. We also have a force leading to digitization of higher digitization of economic activity, including production processes, and less globalization. It's not a reversal necessarily of globalization, as we saw, but in some respects, the inward orientation of some countries, and it was mentioned, the fear with respect to supply shocks, will lead both global value chains to accept paying a price in terms of higher costs, but diversifying from having single source of provision, but also governments. There will be a dash for substitution, import substitution of medical equipment and medicaments, as it was already at play, something in that direction. But also, you know, even as President Macron said it out loud, and we're going to watch this. Well, we also are likely to see some, let's say, deepening of the fight, when we call it, dispute, technological dispute between China and the US with respect to 5G and also on finance. Now, how this affects Africa. There will still be scope for the path that some African countries were finding in developing manufacturing activities, particularly manufacturing activities as transformation of raw materials, of agricultural goods. Definitely, there will be some recovery of commodity price, not necessarily so in the case of oil, but definitely so in the case of foodstuff and other materials. So the track of economic progress that it was being followed by many, most African countries can be easily recovered. It's not at stake in the sense that the African countries would lose them because of what I described. But let's say if it was already hard for Africa to reproduce the East Asian model of labor-intensive manufacturing development, even if there will be scope for some countries to go that path. I think of Ethiopia and the ability to receive production processes from China into leather-intensive products. But overall, the dependence by African countries on replicating the East Asian model is more difficult. Among the reasons, as I said, because digitization, the deeper levels of digitization will definitely provoke some re-onshoring of some of the manufacturing activities that were made easier for Asia to develop. So economic resurgence can come back, but it will depend dramatically on in fact, the issues that we are going to probably discuss in our third section, related to governance, related to economic policy making. A chapter on the Belt and Road. Definitely, the Belt and Road is quite important, particularly for some African countries. I don't think there will be any setback, but certainly, let's hope for no retrenchment in the economic integration between China and, for instance, Europe, because that economic integration between China and Europe was to exactly provide some spillover opportunity to African countries, beyond, of course, the infrastructure investments that were embedded in it. It will depend a bit on how the issue of debt of African countries is also solved. By the way, Grant mentioned debt relief will be good for all African countries, but keep in mind, as I said in my own answer in the first session, Zambia says yes. But if you ask Ivory Coast, Ghana, and Senegal, they will say no, we don't want them right now, because they're still looking forward to re-engaging with financial markets on a normal, conventional way. So, yeah, sometimes, donor countries, they all come with their well-intended proposals overall that make all sense from a humanitarian view, whereas this is not necessarily the same view that is there on the, as I have had experience dealing with the country demand side. I can tell you, I heard from the authorities from the three countries that I said that they don't want that relief as of now. They're still hoping to restore normalcy without the scars of a debt renegotiation.
Okay. Thank you very much. As it happens, the next question is specifically for Grant Harris. Grant, I'd like to ask you what measures specifically and realistically African countries and African governments can take now to best navigate these choppy global economic waters ahead, which is a context of certainly a global recession and very likely more protectionism and less cooperation over the next few quarters. What can they do specifically, in your view?
There are a few things that can be done, and other panelists have touched on them. And to pick up on the debt relief issue, I think it's a great point and clarification by Ottaviano. Countries have differing views, but there are also different things when we throw out the term debt relief in terms of whether it's more of suspension to help countries in the immediate term to increase liquidity, which all countries need for their response, or whether it's done in a way that would really disrupt these countries' abilities to access markets going forward. And I'm certainly hearing different things from the African leaders that I'm talking to about what it should look like in a degree of detail. But my basic point in saying that some level of debt relief is needed and warranted is to help buy some space in the immediate term for the measures that I think must be taken. I fully agree, though, needs to be done in a manner that would preserve access to these markets, that wouldn't shake investor confidence to the core. And so that's an excellent point that probably merits an additional round or a future panel as well to really unpack. But going back to this set of questions posed to me, in terms of the immediate term, liquidity strikes me as the foremost issue. And as Jan Isaacson was discussing, stimulus measures so far have been small. Whether the fiscal and the monetary measures are mixed this way or that, the precise mix matters less than the fact that governments are being as responsive as possible. The issue, though, is that the tools aren't exactly there. And so that's where I think, in terms of debt relief, emergency assistance from international financial institutions, other stimulus measures, other things that can add liquidity to the economy would be very important, along with social safety nets in terms of ensuring that even in responding to this public health crisis, that those most in need are, to the extent possible, that we're able to minimize the risk of millions of people slipping further and deeper into poverty. Estimates are saying that tens of millions of people might do so, and estimates say that tens of millions of people may lose their jobs as well. And of course, that's really even just in the formal economy, when we know that the informal economy looms so large in many countries that we're talking about. Part of this will be supporting private companies as well, tax waivers, getting development finance institutions with loans, anything that can be done to support. And I would say, more on a personal observation, I think countries will make a very strong case for more assistance if they are as transparent as possible in the spending and the allocation. I was in the White House during the Ebola crisis, and I saw differences in terms of where corruption would creep in as money was given and it was spent quickly and there were more opportunities. And I think making a strong case to how the assistance is spent and how it's being used will open the doors. That's the immediate term. I don't think any of those recommendations will shock anyone. Going forward, I'll be even less shocking in saying that there's no secret sauce beyond the economic governance and the policy issues that I think we'll be talking about more in this panel and the subsequent round. Consistent policy, diversifying economies, wooing investment and really competing for capital. It's very much about job creation, and the IMF has estimated that you need to create about 35 million or so jobs every year just to absorb the growing young population across the continent. And that was pre-COVID. That was pre this massive shock that we're talking about. So I would say that'll be an important element. A previous speaker mentioned regional integration as well, and I think that's important, again, to pursue the African Continental Free Trade Agreement, as has gained a lot of momentum before COVID, but that won't be a panacea, and it won't solve these problems, as necessary as it is. So those are my immediate term thoughts, and then going forward, I think we can talk about that a bit more as well, about the strong economic governance and the strong investment climates that are going to be required to really pursue the inclusive economic growth that African states need.
Thank you, Grant. The next question goes to Jan Isaacson. Jan, many African states are dependent on natural resources income. How strong an impact is the fall in prices and demand having in these nations? And what can they do to compensate this impact and diversify in the future?
Yeah, the dependence on natural resources differs a bit between the different African countries, but overall the continent, of course, is the continent which is most dependent on export of raw materials, both mineral, non-mineral, and services. This swift and dramatic downfall in both supply and demand of all goods and services in other parts of the world has then led to a stagnation in demand for the major part of most African exports. The key goods we are looking at in Africa, moving from down south up to the north of the continent, is diamonds and gold, platinum, copper and aluminum in the south, and oil on the west coast, grains, coffee, tea, and livestock in the east. Only in the north do we have some manufacturing industries, mostly in textiles. The African Development Bank estimates that Africa will lose between 35 and 100. That's a big gap due to the fall in raw material prices caused by the pandemic. The World Economic Forum estimates that the global losses for the continent will be in the order of 275 billion. So here we have a real risk that the inequality gap in Africa will worsen in the coming years. All of this prospect does seem critical. Some commentators have a more positive angle on the situation and say that the scenario has elements that will make some countries bounce back quite fast and will propel development of new industries in the manufacturing sector, which has long escaped Africa. Talking about the ECA, the Eastern African part of it, they have in a paper pointed to the possibility of a bounce back for East Africa. The argument is twofold. First, the infection rates are relatively low, and this is caused by the predominance of rural economies, high share of population in the rural areas, and the youth of the population. About half of the population is under 20. Secondly, they are not commodity exporters as much as commodity importers. And the economies of the two major sources of imports, China and Europe, are working at heavily reduced speeds. This is more or less forcing the countries to seek other sources for their imports. I quote what they had said in the end. Regional manufacturers will need to rise to the challenge and fill the void left by reduced Chinese and European imports, not just for the period of the crisis, but for the future. In this context, the crisis is underpinning the importance of the African market and an urgency in implementing the African continental free trade area. They have put together a table of numbers, and based on the IMF Regional Economic Outlook for April 2002 and the EEC, their own calculations, it seems, weighted together for all of East African countries, they grew at a rate of 6.4 in 2019, and they expect 1.4 in 2020. Only 1/3 of the countries have negative growth rates. They all managed to keep above the negative region. In 2021, they say that growth will return at 4.8, which does appear, of course, to be under the rate of the 5 last years, but it's a sort of respectable growth rates. So that leads me to think that some, at least, have discovered some bright spots. But of course, a number of questions can be asked, and it's clear that the big oil and gas and mineral exporters do have different structures and realities to contend with. Now, what are the devil's advocate questions? One is, if the Chinese and European imports could have been contained through other policies and brought the possibility of diversification in under circumstances which were less serious than the corona reality. Couldn't that have been done? Why didn't they do that? And also, would local regional demand, local and regional demand, be likely to hold up and secure reliable markets for local and regional import substitution? Of course, the latter is now dependent on the extent to which fiscal and monetary policies can have the adequate stimulating effect. So there is a, well, I wouldn't say sunshine story, but at least it's not all terrible gray, and we will see whether this reality that they are drawing up actually can be seen in the future.
So a glimmer of hope, Jan. Thank you very much. Next question is one that interests me particularly. It's for Jean-Louis. Jean-Louis, Africa is the continent with the youngest population. Is this an asset or a disadvantage at this moment? And how can governments and companies use this as an opportunity, creating the strong internal markets that we've just discussed?
Yeah, it's a very good question. I mean, let me try to structure my answer in sort of five pieces. Mm-hmm. The first thing, which I think is worth highlighting, is that in terms of the age structure of the population, we have lots of previous historical experience for parts of the world, such as China 40 years ago, which had the same sort of structure of the population. And what the Chinese were able to do is they were able to harness this, what's, for lack of a better term, this generational dividend of when you have a relatively young population. And one of the key manners in which the Chinese did this was essentially through the taxation system. They created massive distortions. Okay, no one is gonna say that this is laissez-faire capitalism. They created massive distortions, but there's some lessons there in terms of the fiscal setup and tax policy in particular. Because remember, one of the big problems in sub-Saharan Africa, less in North Africa, but one of the big problems in sub-Saharan Africa is the lack of a tax base, right? I mean, and the fact that income tax basically that doesn't exist. Second thing, this leads me to a second point, which I think is key also in terms of this generational structure, and it's been mentioned by a few of the other speakers also before, is the quote informal sector, unquote. I mean, being in Geneva, of course, this is where the term was coined, but it's in some sense it's a really bad term, because in most countries in sub-Saharan Africa, and if you exclude natural resources, you have very small number of quote formal sector firms, and then the informal sector is basically the whole darn economy. Again, here there's some interesting experiences in other parts of the world which could be harnessed by African countries in terms of how you deal with the informal sector, how you harness the fiscal capacity that you can extract from the informal sector instead of trying systematically to, in some sense, quote, formalize it, unquote. There's experience in Brazil with this, which has been quite successful. And in the Asian context, has been success in Vietnam in terms of and remember, the informal sector, that's where the young people are. They're the informal sector. Third point, and this is an old topic. I guess I'm turning into an old grumpy development economist. An old topic which was quoted by a great development economist, Michael Lipton. This is urban bias, which is still prevalent in Africa. You see it in terms of infrastructure development. You see it in terms of monetary policy. Just think of the CFA franc. Well, this may be changing soon, but this massive urban bias, which penalizes agricultural sectors. And again, we have to worry about urban youth, but we also have to worry about the agricultural sector. And this is also something where the increasing agricultural productivity is sort of one of those elephants in the room that we don't seem to ever talk about. And this has always been a problem. Fourth point is, let me just hammer home the thing, call it what you may, but whether it's for young people, but especially for young people because they're the majority of the population in African countries, you've got to get the institutions right. This is just the overarching theme. If there's anything that development economics has taught us over the past 30 years, is that what matters, you can overcome just about any structural problem if you get your economic institutions right. And let me stop actually with the fifth point, but which is in some sense a sobering point, and that is the fifth point would be generational frustration. So we're not seeing that so much in sub-Saharan Africa, but remember what we saw in the recent past in North Africa. Remember the Arab Spring, remember Tunisia. I work a lot in Morocco. When I'm in Morocco, again, this is just sort of, you know, the sights and smells that you get. But when I'm sitting having tea with my Moroccan colleagues in their living room, what the most present, the greatest presence are these forlorn youths who are overeducated as lawyers or whatever, and who don't have any outlet for their educational talents. So the danger in some sort, in some sense, in sub-Saharan Africa, given the youth of the population also, is if governments don't get their acts together in terms of economic policies, and especially in terms of economic institutions, and I'm not even talking about democracy here, okay? That's not the point I'm making. I'm making very much sort of an Ashimoglu type point in terms of economic institutions. But this can be a powder keg. It can be an absolute powder keg, and African governments will ignore this at their own peril, and it might turn from being an opportunity into actually being a ticking time bomb.
Thank you, Jean-Louis Arcan. And to finish this second round about testing African resilience and amid the global economic slowdown, the last questions in the second round goes to Alan Hirsch. Alan, what progress has been made in strengthening economic resilience on the continent, be it by individual countries or regional organizations?
Thank you, Sean. Question is, I suppose one could ask, is relative to what or relative to when? So I'm going to take a fairly long view and say that, fairly long view, the last 25 years has seen quite a lot of progress, quite a lot of change, quite a lot of improvement in the resilience of many parts of Africa. Jean-Louis has talked several times about vulnerability, and Africa is vulnerable in many ways, but compared with 30 years ago, compared with 25 years ago, there's some significant changes. I'm going to focus on some of them. Firstly, health. Health systems, going along with the reduction of poverty. The last 25 years has seen really significant changes. You can see them in the human development indexes, most obviously. Similarly, and also evident in the HDIs, access to education. Quality of education may not be fantastic, but the availability of educated people, and Jean-Louis has talked about it in a negative way, but in most African countries, the demand for skilled labor and the premium for skilled labor is very high, which suggests a significant demand. The fact that education has broadened and deepened has meant that Africa now has a much more capable and flexible labor force than it did 25, 30 years ago. Again, compared with the rest of the world, we've got a way to go, but we're more resilient than we were. Another factor would be economic diversification. Some African countries, not most, but some African countries, Kenya, Rwanda, Senegal, Cote d'Ivoire, Ethiopia, Morocco, Mauritius, a few others, have become much more diversified in terms of their economic activity. Agriculture, to some extent industry, in a few countries, Morocco and Ethiopia perhaps have made advances in the service sector, in information technology and so on. Now, they are not diversified and they're not highly developed, but they're considerably more diversified than they were 25 years ago. Okay, fourth point, governance. Back to the governance point. Better governance makes countries more resilient, where governments are transparent and accountable, and particularly as we have seen during this period of the response to COVID, the COVID-19 crisis, where they are trusted or relatively trusted by their citizens, they have been able to respond more effectively to the crisis. And in some African countries, they have. Again, I would say over the last 25, 30 years, there's been a broad trend towards the improvement of governance. Perhaps that reversed over the last 10 years, but we haven't got back to where we were before. We're a lot better than we were before. Then a speculative point, in a way, perhaps because of the lack of development of African agriculture, subsistence agriculture provides a kind of a shock absorber. What I've seen happen in a number of African countries in periods of recession or economic setbacks is that people move temporarily or in the medium term back to the countryside, which in many African countries still provides a kind of a shock absorber. So that's a different kind of resilience. So those are a number of examples at the national level. At the regional level, I'm just going to give a couple of examples because I don't want to take up too much time, but there's definitely a thickening and a deepening of institutions at the regional level. One example is monetary integration. Monetary integration can reduce exposure to crises that come from beyond Africa by increasing making it easier for African countries to trade with each other and to do business with each other, generally to invest in each other, and so on. And Africa is moving towards a continental payments and settlement system. But in the meantime, we already have common currency in Southern Africa. There's a monetary union. In West Africa, there's a much bigger monetary union. In East Africa, they have common systems of payment and settlements, which do virtually everything that a single currency should do without the obvious disadvantages of a common currency, which we've seen recently in Europe in particular. So monetary integration has proceeded in Africa, even though it isn't going to be a common currency, I don't think. It's going to be a continental-wide system of payments and settlements, which is going to increase the resilience of the continent. Just one more trivial example. In East Africa, they had a problem in terms of cross-border movement of goods because the countries of East Africa were worried that the people coming from their neighboring states were infected with the virus and hadn't been detected. They relatively quickly were able to come up with a protocol which managed the system, which basically created a relationship of trust between the countries of each Africa so that they trusted each other's certification of the drivers that were crossing these borders. Now, this is something that the EU also, an important achievement, I think, of the EU in the crisis was to create what they called a green lane, a way of moving goods across borders and people to some extent. Africa is also somewhat able to achieve that now, and what I think it shows is, in the East African case, the value of gradually but increasingly deep institutions being built through the regional process. So it's relative, and it's not, we don't have the institutions that much of the rest of the world has yet, but we've seen significant progress over the last 25 years.
Thank you, Alan. That brings us to the end of our second round. The third round is about the crucial issues of looking ahead. How can we overcome Africa's development challenges? We're heading to the third round. We're running a bit short of time, so I'd ask all the panel members to keep their answers slightly shorter in this final round, maybe a couple of minutes just to give us a brief idea so we can stick to the allotted time we had. The first question in this final round is for Ottaviano. Ottaviano, how much do Africa's development prospects depend on improvements in governance? What are the strategies that we need to see put in place urgently in this context?
Thank you. I would say maximum. The evolution from low income levels per capita to middle income levels and high income in all countries, with no exception, can be described as an evolution from that encompasses the accumulation of human capital and of what economists call factors behind total factor productivity. These are all intangible assets, but they have all in common one thing: the presence of good governance, which means a structure of incentives that rewards the accumulation of assets, intangible assets, by the members of a country. Jean-Louis said it all. One needs economic institutions right, which is the expression of good governance, so as to, let's say, incentivize the economic engines to accumulate assets, to acquire human capital, to look for strategies of wealth creation, asset creation, rather than rent seeking. And in the case of Africa, regardless of whether the African country is natural resource rich or not, it matters. In all countries, with no exception, governance is key in management of natural resource richness, however it be high or low, so as to make sure that rents are not captured in a way that stifles the accumulation of assets. That's what makes the difference between, for instance, natural resource rich countries that are today high income and those natural resource rich countries that are still fighting against low income levels. We have a natural experiment in Africa that tells it all. Just compare Zimbabwe and Botswana, both benefiting from the same underground kind of wealth, natural wealth, but given differences in terms of governance. They were led, the countries went and ended up in very different positions when it comes to the quality of social inclusion, to the levels of income, to debt rankings, to the quality of public management, and so on. So what will make the difference? And by the way, I spent many years, I did the recent work trying to gauge the connections between natural wealth and economic development in the region, in Africa. And clearly the correlation with the classification of governance levels, according to some indicators used by the World Bank, is loud and clear. So Africa needs definitely improve the business environment, which is an important component of the economic institutions, and also make sure that the natural resource richness is not wasted or captured by some elites without being transformed into transformed into human capital and other assets pertaining to the population as a whole. Governance is key, fundamental.
Thank you, Ottaviano. The next question goes to Alan. Alan, is it still realistic for African citizens to aspire for development?
Here, I also have to pay tribute to a great development thinker, Thandika Mkandawira, who died earlier this year. One of the things I remember Thandika saying, something that stuck in my brain, one of the many things that he said that were memorable, was that one of the most important changes in Africa in recent decades is that Africans were expecting more. They were measuring the governments by the quality of the schooling, healthcare, roads and rail, but most importantly, they were measuring the governments by economic growth rate. And we know that the reason was that there wasn't improving. There were improvements in poverty, in the growth rate, and so on. I think that today, heads of state in Africa, apart from the least accountable ones, they look at the countries next door and they see if the neighbors are doing better and begin to worry about their reputation. That accountability, that expectation of young Africans, which is greater than ever before, is I think one of the most important forces driving our movement forward. I think it's not only realistic for Africans to aspire to development, it's important and it's exciting that Africans aspire to development so much more today than they might have 20 or 30 or 40 years ago, as Tandika pointed out. So there's no, I think Ottaviano earlier said, we have been diverted from our course of growth. It's going to be difficult, more difficult over the next few years. But I don't think there's any case that could be made that the gains of the last 25 years have been lost. And our young people pushing us forward, I think, are our most important asset.
Thank you, Alan. The next question is for Jan Isaacson. Jan, if you succinctly explain to us how can this path of development in Africa be made more sustainable and more durable?
Well, I should start saying that it's a very difficult question, but I will not start in that way. I would say the solution is, or I'll say one of the solutions is right in front of us. The international community, as you all know, has managed to agree on the Sustainable Development Goals. And they are as created for the African countries. Nearly all the points are relevant to them. However, with this crisis, the attainment of the goals are threatened more than ever. The reduction in social protection programs means more vulnerabilities. There are significant job losses, particularly the informal sector, where the job protection is weak and levels of inequalities already are very high, and they will continue to increase. My feeling is that adherence to the set of goals laid down in the SDGs and the policies which are necessary to attain these goals give the best recipe for making the path of development for Africa more sustainable. Of course, no solution are quite clear without any troublesome facts around it. And there are two facts that I think are very important, setting brakes to the achievement of these goals. First, I believe that there is a growing feeling among Africa's development partners, as well as even the African countries themselves, that the impact of the corona crisis on top of the already existing barriers makes the whole project near impossible. And we may just as well realize this and adjust downwards. If this kind of feeling spreads, it would, in my opinion, be disastrous. One of the most important points around which the international community should rally is to uphold and redouble efforts to realize the SDG goals. I think that is incredibly important, that nobody starts thinking about slacking down because we have more trouble than we had before. It's the opposite way around. And the second problem is that we're in a time when the world more than ever needs to pull together. But at the same time, many countries, not only one, are skeptical to international cooperation and international institutions. To mention the most important, I would say the US government under Trump, who has pulled out of the WHO and considers, as Trump does, international cooperation as a zero-sum game, is a major problem. We have to overcome these problems in one way or another. I don't have the solution for that, but if there is a recipe for a more sustainable development path in Africa, I would say the Sustainable Development Goals takes the prize. They are covering not only the economic necessities, they are covering the whole field of social and economic problems. And I think I could go on mentioning the SDGs and talking about them. We have the 5 Ps, the people, the planet, the prosperity, the peace, and the partnerships. For Africa, the people is under the label of the highest proportion of people in the world living under extreme poverty. We have to eradicate extreme poverty. The planet, the whole climate issue, the prosperity, the fight against inequalities, and peace. As it said, there can be no sustainable development without peace. So it all fits, and this is what I would promote as the way ahead for making African development more sustainable.
Thank you, Ian.
Thank you very much.
Okay, next question goes to Grant Aries. Grant, how can the path of development, what is the role of the private sector, internal as well as foreign direct investment, in the development process?
I will keep this extremely short. The role of the private sector is absolutely critical. And according to the African Development Bank, the estimates, which vary in terms of Africa's infrastructure needs, are around $130 to $170 billion per year. And that what is actually spent right now falls short of that by between 68 billion and $108 billion per year, meaning there is a massive gap, and public sector spending just wouldn't be enough to fill that, even if it would be the right course. And that lack of infrastructure shaves off an estimated 2% of GDP growth across African states annually. I completely agree with the other panelists about the extreme importance of governance. It all comes back to that, the investment climate, the policy certainty and clarity. And I would note as well that Mercer and other organizations that have looked at the types of risks present, they've actually shown that infrastructure investments in Africa often have a lower default rate than compared to other regions, meaning that the global perception of risk doesn't really always match up with reality. And that is because development finance institutions, risk support, and other mitigation have really been used in a helpful way in many of these projects. So the bottom line is attracting this investment, competing for capital globally to get this cowardly capital to the African continent and to African states will really be the difference in supporting economic growth and creating jobs or not.
Thank you, Grant, for the succinct and very complete answer at the same time. Final question is directed at Jean-Louis again. How can Africa position itself within this global technological revolution that we're currently seeing, which will be accelerated as a consequence of the COVID-19 pandemic?
Yeah, this is sort of a $64,000 question. I show my age when I talk about the $64,000. Let me just give 2 examples. So how can it? Well, Africa already is. It just has to do it more. So let me give two examples. So the first one has to do with telephones. So I mean, I'm based in Geneva. When I go and have a drink in the Paquis and the sort of the low down district in Geneva, there's still a lot of places where I can't even pay with a credit card. Okay, they only take cash. When I get off a plane in Beijing, I only pay with my phone, with my Alipay or my WeChat. And there are lots of African countries where you can do the same thing. So in terms of like mobile money, think of M-Pesa, think of Angola, right, as well, right? There's lots of African countries which are way ahead of a country like Switzerland in terms of your ability to transfer and pay using your phone. So Africa, when it wants to do this, can do this without any trouble. let me give a second example, and I'll conclude with that, which is, I think, even more high-tech. When I go to my supermarket, right now I'm on the French side of the border, just the other side of the border from Geneva, I want to buy cherry tomatoes. So what type of cherry tomatoes do I buy? I buy Burkinabe cherry tomatoes. And why do I buy Burkinabe? So criticize me, not low carbon, blah, blah, blah. Okay. But I want my Burkinabe cherry tomato. Burkina's is the one, apart from the fact I'm completely biased, it's one of my favorite countries to work in. But Burkina, there's a town in Burkina, in the Gourmanche areas, which is like the world's cherry, or Africa's cherry tomato capital. And these people in this village, in this small town, they've managed to integrate into a supply chain and all the, the cold chain and everything. And they get their cherry tomatoes in a few days from eastern Burkina Faso all the way to rural France. Now, if that's not positioning oneself within like the global technological setup, I don't know what is. I mean, it's sort of high end and low end. Again, it all boils down to institutions, right? I mean, you put African entrepreneurs or African peasants, you put them on a level playing field, they're going to do as well, if not better, than any other entrepreneur or peasant or whatever in the world.
Jean-Louis, thank you. On behalf of the moderators, I thank the rest of the panel as well for your fantastic answers. And I give the microphone, the virtual microphone, to Assis Malakias for some final remarks. Thank you.
Thank you so very much. I have no final remarks to offer. All I have to do now is to thank everybody, to thank the panelists, to thank the moderators, to thank the audience, the virtual audience out there. Let me just say that this, in terms of content, in terms of the substance of this conversation, it was one of the very best I've had the opportunity to participate in. And let me tell you, Zoom events are a daily occurrence, many times a day. But this has been absolutely outstanding, absolutely fantastic. I'm glad it was recorded. True, we went over the allotted time by a few minutes, but this is a testament to the richness of the substance. I'm very happy that this event was recorded, because at least others will have an opportunity to benefit from the conversation that we all had the opportunity to participate in. We'll have another conversation next month. Hopefully it will be just as rich, but let me tell you, the bar has been set very, very high today. Thank you again to all. We'll see you again next month. Thank you.
Thank you for having us.
Thank you.